Okay, let's unpack this. If you look at the raw numbers defining global finance right now, I mean, the scale is just almost impossible to really grasp. We are staring down what is it, a $150 trillion global debt burden.
A staggering number.
It isn't just big, it's this monumental liability that's, completely unmoored from physical reality. The experts we've been studying suggest that the entire global financial architecture is stuck in what they're calling a precarious interregnum.
A fragile period between two systems.
Exactly. So our mission today is to give you a kind of shortcut through all this complexity. We're going to trace the entire history of credit, starting thousands of years ago, to understand the precise moment where modern finance, went wrong.
And that key error, that shift from issuing real credit, something backed by real assets, to simply selling unsecured debt, which is only backed by promises.
And that history is so vital because it leads us right to what's happening now, this emerging new paradigm, digital credit.
Right. We're analyzing Strategy Inc., which used to be MicroStrategy, because they've taken this highly controversial step. They're trying to engineer a return to asset-backed finance, but they're using Bitcoin, what they call digital capital, as the foundation.
And the main focus for us, for you, is their flagship instrument, the Variable Rate Series, a perpetual preferred stock, or STRC. This thing isn't just another financial product. It's a direct, engineered response to the fragility of that $150 trillion unsecured debt market.
And we're going to show you exactly how it attempts to strip out volatility and offer returns that just fundamentally challenge traditional fixed income.
To really understand the future, though, we have to grasp the archetype of real credit. So we need to start not in some modern bank vault, but along ancient trade routes.
That's right.
So let's rewind. Way past the 19th century gold standard, past the Medici family in Italy, all the way back to the Maurya and Gupta empires in ancient India.
The birthplace of the Hundi system.
The Hundi system.
And the Hundi system, which comes from a Sanskrit word for note or collection, wasn't born from some abstract economic theory. It was a pure solution to a logistics and security problem.
Okay, so paint the picture for us.
Imagine you're a merchant back then. You're responsible for moving valuable goods, maybe fine textiles, spices, from the Gangetic Plains all the way to the huge ports in Gujarat.
That's a phenomenal logistical problem.
Yeah.
How do you pay for goods in Gujarat if moving physical gold across hundreds of miles of bandit-ridden terrain is so dangerous? You just couldn't transport the hard assets safely at scale.
Precisely. So what the merchant would do is deposit their physical gold with a trusted local banker, a shroff. In return, they get the Hundi, basically an IOU.
And the critical component here, the real credit part, is that the issuance of that note was strictly pegged to the gold that was sitting in the vault.
Yes. The shroff was a custodian, a facilitator. He wasn't just creating liquidity from thin air.
What's so fascinating is how sophisticated their instruments were. I mean, our sources detail these systems that show an understanding of trade finance that you'd think only existed in post-Renaissance Europe.
Absolutely. The Hundi wasn't a one-size-fits-all thing. You had the Darshani Hundi, which was payable on site.
Like a demand draft today.
Exactly. It was all about speed and finality. It allowed a merchant to instantly transmit the liquidity of their gold deposit to a city hundreds of miles away. It, sped up commerce.
But the instruments for managing risk and inventory, those are even more telling.
They really are. The Madadi Hundi was payable after a set period, say 90 or 120 days. This was pure trade finance. The credit was based on the anticipated sale of the physical inventory itself, the goods that were actually in transit.
So it was temporary financing, but constrained by the value of the assets being moved.
That's it. And then you get to the Joachim Hundi.
That name just sounds inherently risky.
It was the conditional masterpiece. The Joachim Hundi was basically a combination of credit and insurance. The shroff only promised to pay the IOU if the ship and the goods arrived safely at the port.
Wait, so if the ship sank, if the underlying asset was destroyed?
The Hundi was void. The credit itself ceased to exist if the asset disappeared.
Wow.
It just emphasizes the whole philosophy of real credit. Issuing credit was a productive act, part of the value chain, and it was always constrained by the hard physical reality of the backing asset. You couldn't create credit independent of value.
And that constraint, that direct relationship between the asset and a liability, is what defined good credit for centuries. And it's exactly what started to vanish in the West, leading us right to where we are today.
Yeah, the great decoupling. It didn't happen overnight, but you can pinpoint specific legal and philosophical changes that normalize this idea of unsecured debt.
And the major inflection point wasn't some bank run or an economic collapse.
Yeah.
It was a dry, technical legal change in England, the Promissory Notes Act of 1704.
Before that act, if I owed you money, that was a highly personal contract. If you wanted to transfer that debt to someone else, it was complicated, time-consuming. You often needed a court process.
But the 1704 Act changed everything.
It transformed debt from that personal, hard-to-transfer contract into a negotiable instrument. Suddenly, a promissory note wasn't just a record of an obligation, it became a commodity, something that could be freely bought and sold by third parties with almost no friction.
So the banks realized, wait a minute, we don't just have to manage the assets, the gold deposits.
Right.
We can treat the liabilities, the notes, as a product that we can manufacture and sell ourselves. The whole focus moved away from the quality and the security of the asset.
To the liquidity and tradability of the liability itself.
And this move toward monetizing debt was cemented institutionally, right? Especially in the U.S. with the Federal Reserve in 1913.
Absolutely. Fractional reserve banking, the Fed's mandate to provide liquidity,
Wow.
it all led to the monetization of public and private debt, constantly expanding that pool of promises.
But the final, definitive break, the moment we left the coast and sailed into this unsecured ocean, was 1971.
The Nixon shock. When the U.S. government ended the gold convertibility of the dollar, the last anchor was just gone.
So the old real credit, the IOU against physical gold, was definitively replaced.
Replaced by unsecured debt, backed only by the promise of future government tax revenue and, of course, the ability to print more currency. The constraint was removed.
And now, we live in the system created by that decision. If we connect this history to the current numbers, the gravity of it all becomes so apparent. We have this astronomical $150 trillion global non-household debt burden.
And that debt is not evenly distributed. The U.S. accounts for about 39% of that, around $58.8 trillion, with China right behind. But the raw number, that's only half the story. The systemic fragility is in the timing.
The maturity wall. What exactly is the scale of that threat?
It is massive. 40% of all OECD sovereign and corporate bond debt is maturing. It has to be refinanced by 2027.
And just think about when that debt was issued.
Exactly. During the era of zero interest rate policy, ZRRP, these corporations, these governments, they borrowed money for virtually nothing.
So they're facing a catastrophic interest expense shock. It's like a homeowner whose 2% mortgage is suddenly resetting to 6 or 7%.
Yeah.
The debt has to be rolled over in a high-rate environment.
Precisely. The cost of carrying that debt just explodes. And that interest expense crowds out productive investment. It strangles growth, and it starves the very economy you need to pay the debt back.
And if we connect this to the bigger picture, we're trying to navigate this debt crisis while also facing one of the most capital-intensive tech shifts in history, the AI revolution.
Right. Estimates suggest AI spending on data centers, power, chips could exceed $5 trillion in just the next 5 years. So you have this massive urgent demand for real capital, but the financial architecture is just saturated with these unsecured, expensive promises. It's an unstable foundation.
And this instability is really the springboard for Strategy Inc.'s counter-thesis. The genesis of their digital credit idea is this argument that we must return to the Hyundai principal asset-backed issuance. But we need an asset that's superior to gold.
And for them, that asset is Bitcoin. They point out the failings of physical gold as collateral in the modern age. It's slow, requires constant, expensive physical audits, and the reserves are managed behind closed doors.
Whereas Bitcoin offers verifiable openness, proof of reserves on a public immutable ledger. You know exactly what's there.
And critically, the immutability. Gold is theoretically infinite. Bitcoin is mathematically capped at 21 million units. That strict, provable scarcity offers a confidence that no fiat currency or traditional commodity can really match.
So Strategy Inc. positions itself as the modern Schroff, a Bitcoin treasury company.
Bitcoin is the asset, the gold. Strategy Inc. is the issuer. And the instrument, STRC, is the new Hyundai.
Okay, here's where it gets really interesting. The central challenge for any company using Bitcoin as a treasury asset is obviously the volatility. How do you issue a stable, fixed-income type product backed by one of the most volatile assets in the world?
And that's the innovation designed right into the STRC instrument itself. It's a variable rate series, a perpetual preferred stock. Fixed income investors, they hate volatility. So this preferred stock has a target $100 par value, and it pays a high monthly dividend, currently annualized at 11%.
A variable rate stabilizing a price. That still feels counterintuitive. If the price of the stock drops, why not just keep the dividend stable?
Because the dividend isn't just a payment, it's the primary mechanism for price control. It acts as an automatic stabilizer. Think of it like a dynamic braking system on a car. If the market price of the STRC shares starts to creep above $100, meaning demand is too high, the company reduces the dividend rate.
A lower yield cools demand and gently pushes the price back toward par.
And the reverse is true. If the stock price dips below 100, which indicates selling pressure,
They increase the dividend.
they increase the dividend rate. This immediately attracts yield-seeking buyers who see the effective discount, and it pushes the price right back up to $100. For the preferred stockholder, it effectively strips out the daily volatility that normally plagues products linked to digital assets.
So it delivers a stable, high-yield income stream, and the volatility risk is absorbed by the common stockholders, not the preferred.
That's the design.
That is brilliant engineering. But even with that, fixed income investors need security. They're used to being first in line in a bankruptcy. How does this digital credit instrument secure itself against, say, a sudden Bitcoin price crash?
They address that by building a massive traditional security layer, a segregated fiat liquidity buffer, a war chest. This prevents them from ever having to liquidate Bitcoin just to meet their monthly obligations.
How big is that war chest?
As of early January 2026, the USD reserve stood at $2.25 billion. And the company has stated publicly that this reserve is sufficient to fund an astonishing 21 to 24 months of dividend payments.
2 years.
Almost 2 years of operating runway for the dividend alone, even if they issued no new shares and the company generated zero revenue.
That's an incredible first line of defense. And the ultimate backstop, of course, is the sheer scale of the collateral base itself.
Which currently stands at 673,783 Bitcoin, valued at approximately $62 billion. So you have a multi-billion-dollar cash buffer securing that stock price target with a $62 billion collateral base sitting right underneath it.
That's a level of verifiable layered security that most corporate or even sovereign bond issues just can't match.
It's a different paradigm.
Okay, so now we get to the final piece, the killer app that accelerates the displacement of traditional debt. It's not just the yield or the security, it's the tax structure created by the return of capital mechanism.
This is where you really get the economic alpha, especially for high net worth investors.
Right.
Due to specific accounting and tax structuring, the dividends paid on STRC are classified for tax purposes as return of capital, or ROC.
Okay, let's explain that distinction clearly for everyone. If you earn interest on a bond or you get an ordinary corporate dividend, that's income. It's taxed immediately.
Exactly. ROC is treated differently. Instead of being taxed as immediate income, the IRS functionally views it as the investor getting their own invested money back. So the cash dividend is not taxed in the year you receive it.
So what happened?
Instead, it reduces your cost basis in the stock. This means the tax liability is deferred potentially for decades until you eventually sell the stock.
That tax deferral, it's basically an interest-free loan from the government for as long as you hold the asset.
And it quantifies into a huge advantage. If you calculate the benefit for a high net worth investor, maybe in a 45% combined tax bracket, that 11% nominal cash yield on STRC becomes equivalent to a staggering 20% tax equivalent yield.
And now the whole displacement argument just clicks into place. Why would capital flow into a bad unpegged credit, say a traditional high-yield corporate bond yielding 8%, which shrinks to a meager 4.4% after tax?
When you can get good digital credit, offering a 20% tax equivalent yield, backed by a dynamic volatility stripper, a cash war chest, and $62 billion in immutable digital collateral.
Market rationality just dictates the capital will flow.
And we already saw proof of concept. In early January 2026, Strategy Inc. sold 1.19 million shares of STRC in a single week. That generated $119.1 million, and that capital was immediately used to acquire 13,627 Bitcoin, constantly reinforcing the asset backing in real time.
The Hyundai model, updated for the 21st century, is proving its efficiency.
This deep dive has revealed a really clear historical pattern. The pendulum swings between the solidity of assets like that ancient productive Hyundai and the fluidity and, the danger of promises, which defined the era of fiat debt. Digital credit, through instruments like STRC, is using modern tech Bitcoin's immutability, cash buffers, sophisticated ROC tax structures to restore the speed and security that was the Hundi's original promise.
Which raises an important question.
The ultimate question.
The ultimate question for you to consider is this. If digital credit instruments, backed by hard, immutable assets, can offer investors a 20% tax-equivalent yield secured by multi-billion-dollar cash reserves, what is the viable future for the $150 trillion unsecured debt market, which is already burdened by these looming maturity walls and the crippling cost of refinancing? Does the entire future of fixed income lie not in trading unsecured promises, but in these sophisticated asset-backed equity-linked instruments?